Welcome to Anu's classroom. While we were talking about the comparative common sense and trend statements, we talked about Dupont analysis and Altman's z-score. And I said that we will be doing a separate video on both. So this video will be covering about Dupont analysis, and we'll cover about Altman's z-score in another video. So let's get started. By the end of this video, I hope that you have an understanding about what Dupont analysis is, what are its advantages and disadvantages. So let's get started. So, Dupont analysis is a framework used for analyzing the fundamental performance of a company. It is used to decompose the different drivers of the return on equity ratio. So, return on equity is calculated as the profit after tax divided by equity. And this decomposition of this return on equity will allow investors to focus on the key metrics of financial performance individually to identify the strengths and weaknesses. So how do we decompose this return on equity? There are three major financial metrics that drive this ROE. That is operating efficiency, which is represented by the net profit margin or the net income, which is divided by total sales or revenue. We have the asset use efficiency or the asset turnover, okay, which is measured by asset turnover ratio. We have financial leverage, which is a metric which is measured by the equity multiplier, which is equal to average assets divided by average equity. So ROE can be split into three components: net profit margin, asset turnover, and equity multiplier. What is net profit margin? Net profit margin is the ratio of bottom line profits compared to total revenue or total sales. This is one of the most basic measures of profitability. So profit margin is nothing but net income divided by revenue. One way to think about this net margin, okay, or this net profit margin is to imagine that you are in charge of a store which sells a single product for 1 rupees. After the cost associated with buying inventory, maintaining a location, and paying employees, taxes, interest, and other expenses, you, the store owner, will keep 15 paise in profit from each unit sold. That means your profit margin is 15%. What is asset turnover ratio? It measures how efficiently a company uses its assets to generate revenue. Again, let us imagine a company which has 100 rupees of assets, okay? And if it made 1000 rupees as total revenue last year, then these rupees 100 worth of assets generated 10 times their value in total revenue, which is same as the asset turnover ratio. So the asset ratio or this asset turnover ratio can be very helpful when we compare two companies that are very similar. Why? Because average assets, which will include components like inventory changes and all, in this ratio can signal that sales are slowing down or speeding up earlier than they would show up in their other financial measures. So if you're comparing two firms with equal, say, 100 rupees assets, if one firm gave a return of 1000 rupees and the other firm only could signal 900 rupees, then comparing those two, you can think of why that second firm only got 900 rupees with the same asset, especially since they are similar organizations. Okay, so that is what is asset turnover ratio. Next is the financial leverage or the equity multiplier. It is an indirect analysis of a company's use of debt to finance its assets. So assume that the company has 1000 rupees worth of assets, okay, and in that 250 rupees is owner's equity. So the balance equation in the balance sheet will tell you that the company has 750 rupees in debt, right? So if the company borrows more to purchase assets, what will happen? Again, this debt to equity ratio, it will increase, right? So the accounts used to calculate the financial leverage are both on the balance sheet. Analysts will just divide the average assets by average equity rather than the balance at the end of the period. So financial leverage or equity multiplier you can find by dividing average assets with average equity. So the total asset, okay, divided by the owner's equity in that will give you the financial leverage or equity multiplier. So why exactly are we performing Dupont analysis, and is there any drawbacks for this? With Dupont analysis, what investors and analysts can do is they can dig into what drives the change in the return on equity, or why this return on equity is considered high or low. That is, in other words, you can say Dupont analysis can help help deduce whether its profitability and use of assets or debt is driving the return on equity or not. So are there any drawbacks? Yes, there is. It is expensive. right? But it still relies on accounting equations. That is the data which can be manipulated. See, this entire DuPont analysis you're doing with your financial statements, and financial statements can be manipulated. There are ways to perform fraud, which we will study in the upcoming videos. Okay, so these are done on data which can be manipulated, and if you are by any chance working on a manipulated data, then the findings of DuPont analysis will definitely not be trustworthy. Plus, even with this comparative, even with its comprehensiveness, this DuPont analysis actually lacks context as to why the individual ratios are high or low, or even whether they should be considered high or low at all. So those are the drawbacks of DuPont analysis. So I hope you got a picture of what DuPont analysis is and what are its various components. If you did, if you found the video helpful, please let me know that by hitting the like button or the dislike button. If you find our classroom worth, then consider subscribing. And if you have any doubts, leave a comment and share about us amongst your friend circle so that we can grow our community and help each other in fulfilling this MBA degree. Thank you so much, and until I see you in the next video, bye bye.